Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
We've all heard of diversification. Don't put all your eggs in one basket. You want stocks, you want bonds, you want real estate commodities, so on and so forth. But have you heard of tax diversification? I think for a lot of you that are watching this television program right now, this will play maybe even a more important role than your overall diversification. That's what we're going to get in today, so stick around. My name's Joe Anderson, president of Pure Financial Advisors. I'm with my partner, the big man right over there, Big Al Clopine. We're going to break some things down today when it comes to taxes, when it comes to retirement income, because when you take a look at risks, when it comes to your retirement, taxes might be one of the biggest risks that can give you the success or failure, or probably be your biggest expense. That's what's on my mind today. So let me break it down for you real quickly here. Is that when you look at saving money, there's different pools of money that you can save in. There is a taxable pool. This is just stocks, bonds, mutual funds, real estate. But here's the thing. Most of your assets are in this tax-deferred pool, such as an IRA, a 401k, a 403b. All of the money that you pull out of this account is going to be taxed at the highest of rates, ordinary income. Let me ask you this. Do you have any money in this pool here, tax-free? There is no better rate than zero, folks. There is no better rate than zero. What we're going to get into is figuring out ways that you can create tax-free income in retirement. And guess what? It might be easier than you thought. Let's bring on Big Al Clopine to break it down. Alan, there is no better rate than zero. Tax-free is always a good rate when you're talking taxes.
I would agree with you, Joe, and there are actually a lot of ways to create tax-free income. And we're going to focus on a couple big ones, but towards the end of the show, we're going to give 6 or 7 more bonus ones, because there really are a lot of ways to create zero tax, I guess, in retirement. So let's start out with today's show. So it's creating tax-free income. We want to focus on Roth IRAs. And if you're not that familiar with a Roth IRA, it's a special kind of retirement account that grows tax-free. All future growth, income, and principals tax-free. What you give up is you don't get a current tax deduction, but that's a great way to create income. A second way is capital gains. When you sell a stock or bond or real estate outside of a retirement account and you held it for at least a year, you get a special capital gains rate, which is 15% for most people. Some people pay 20%. But did you know you can actually pay 0% tax on your capital gains? We'll get into 2 methods to do that. And as I mentioned, probably 6 other ways. Maybe we'll throw in 1 more bonus, maybe a 7th way to create tax-free income. And Joe, this is one of those things that in retirement, a lot of people don't think about taxes. And they have their pension, they have their IRA, they have their Social Security, maybe they've got some real estate. It's all taxed at ordinary income, the highest of rates. Capital gain rates are better, but tax-free is better still.
Right. I think here's the deal is that I think a lot of you still think that you'll be in a lower tax rate in retirement. That's not the case at all for a lot of our viewers, because where's your assets held? As Al just said, it might be in your 401k, you might have pension, Social Security, you might have some real estate income. All of that is taxed at the highest of rates. So what we want to dive into is take a look at a little bit of a diversification strategy when it comes to creating retirement income, because if you can control your taxes in retirement, I'm telling you what, you can take less risk in your portfolio, and you take the uncertainty of where taxes are going to go. So the first 2 main ones I want to get into is the Roth IRA and zero capital gains rate. So let's start with the Roth, because there's a lot of there's some confusion here, misconceptions, misnomers, or whatever you want to call them.
Yeah, misconceptions. So Roth IRA, as I mentioned, it's a special type of retirement account. Now, you do not get a current tax deduction, but in exchange, you get tax-free income, growth, and principal for life. And this is a big deal. I mean, you think about income, your own income in retirement. If some of it's tax-free, you can stay out of these higher tax brackets. And then if you pass away, your spouse gets it tax-free. If you both pass away, your kids will also get it tax-free. And Joe, when you think about Roth IRA, some people ask us, what's the rate of return?
Right, yeah, what is the rate of return? Is a Roth IRA more risky, or is it has less risk? Is it like a CD? No, you can, from an investment option, you can invest in anything that you choose inside a Roth IRA. If you like mutual funds, if you like individual stocks, if you like real estate, anything is fair game except for collectibles in life insurance. So if you're looking at the investments inside your Roth IRA, it's unlimited. So if you look at, hey, I really like this mutual fund inside my 401k plan, you can invest basically in the same exact investment in a Roth IRA. What you want to do is you want to take a look at asset classes, of course, that have a higher expected return and place those into the Roth, because you never ever have to pay taxes on those dollars again. Yeah, you don't get a tax deduction, so you put in $5,000, but that $5,000 grows to $20,000, $50,000, $100,000. Every last penny of that dollar comes out to zero tax. There is no better rate than zero, Al.
That's absolutely right. And so now we know we like Roth IRAs. How do you get money into Roth IRAs? There's really two ways to do it. One is a contribution and one is a conversion. So let's start with a contribution. That's probably simpler. Who can do a Roth contribution? Well, you must have a job or you must be self-employed. In a job, you have self-employment, you have Social Security withheld. When you're self-employed, you pay that self-employment tax. If you have that, you have earned income, and you're allowed to do these Roth contributions. Believe it or not, it's true for any age. So if you're 12 years old and have earned income, you can do a Roth contribution. If you're 85 years old with earned income, you can do a Roth contribution. And Joe, the amounts it depends how old you are.
Right. You know, when it comes to contributions, you can go $5,500 into a Roth IRA. Now, if you're over 50, you can do a $1,000 catch-up, so $6,500. It's the same as last year. Now, if you have a Roth 401k, now this is something pretty cool here, that you can at least get into $18,000 if you're under 50. Check your employer. You might have a Roth provision already in your 401k plan where you can put a heck of a lot more money into that Roth 401k than a Roth IRA. If you are over 50, then there's another catch-up. So you can put up to $24,000 into the Roth 401k plan, but double check your employer. I would say at least now 50 to 60% of all large employers have this Roth provision inside the plan. Now, why do you want to do this? Is that because what we see is that people are putting themselves into higher tax brackets in retirement because all of the income that you are creating is classified as ordinary income, which is the highest of rates. If you can get money coming to you tax-free and taxable, guess what? Now you have a little bit more control. You can invest in the same exact investments inside your 401k in a Roth IRA, but start building up this Roth pool is going to pay off in spades for you long term. There's also some other characteristics about the Roth tax-free income. We're going to get to a lot more of this when we get back from the break. If you're at all curious about how to create tax-free income, you don't want to go anywhere. We'll be right back. Show's called Your Money and It's Your Wealth.
Hi, I'm Matt Balderston, Certified Financial Planner with Pure Financial Advisors. Did you know, according to U.S. News, when switching jobs, there are 3 ways that you can avoid paying taxes or early withdrawal penalties from your 401k. First, you can leave it in your old 401k. Second, you can roll it over to an IRA. Or third, you can transfer the balance into the 401k at your new employer.
Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson, Big Al Clopine hanging out here today, talking about tax-free income. If you're just joining us, we talked about the Roth IRA, Roth contributions. Stick around for this segment because we're going to talk about how to jumpstart your Roth IRA. Before we get into it, let's go to the true-false.
My Roth IRA is not subject to required minimum distributions, or RMDs for short. And I guess we should first of all explain that's true. And secondly, what is a required distribution? It's when you turn 70 and a half, your regular IRA, and in most cases your 401k, you got to start taking money out, whether you want to or not. And it's because the IRS wants you to withdraw the money out of those accounts during your lifetime so you will pay taxes on them, because you have not already paid taxes on them. When you have a Roth IRA, you do not need to take a required distribution, and unless you inherit a Roth IRA and you're not a spouse, then you do need to start taking a required distribution, but there is no tax to pay. Clear as mud, right?
Yeah, you want to just get into the whole tax code there, Al?
Yeah, exactly.
So if your sister inherits it, and her age is 15,
and if your dog gets it,
you have to go to Pub 90 on the IRS code to figure out exactly what the life expectancy is, and that's her RMD. A couple of things. Roth IRA contributions. To recap, anyone can contribute to a Roth IRA at any age as long as you have 2 things. You have to have earned income, so that means employment, self-employment, or W-2 wages. There's also an AGI limitation. So if you're single and if you make more than what? But $131,000 you cannot contribute to the Roth IRA. And if you are married, if you make more than $193,000 of adjusted gross income, you cannot contribute to the Roth IRA. Then we can go to the backdoor Roth IRAs, Al, if you want to talk real technical about a whole bunch of different things. But we only have a half-an-hour show, so we're just going to keep it light. Let's go to Roth IRA conversions. Now, this is something completely different. This is getting money into a Roth IRA. Anyone can do this, anytime, any age, as long as you have a retirement account. Misconceptions galore here when it comes to Roth IRA conversions. This came out, right, 1997, anyone can do a Roth IRA conversion, but in 2010, they changed the law. Actually, the law was on TIPRA in 2005, but starting in 2010, anyone can do a Roth IRA conversion. I get this all the time. Joe, I cannot do a Roth IRA. I make too much money. Joe, I cannot do a Roth IRA. I do not make any money. No, that doesn't matter. If you make zero income or if you make $1 million a year, you can do a Roth IRA conversion today. Everyone should at least take a look at it because it's a strategy that you can start building up your Roths and get a lot more money into the overall tax-free pool. It's a huge, huge deal. If you think tax rates are going to go up, you absolutely have to take a look at this strategy and start building some tax-free income. Al, there's other directions that people can go to look at tax-free income. Why don't we go there?
Well, that's absolutely right. So a Roth IRA is one way to get tax-free income. And let me just show you in terms of how it looks here. So a contribution is taking some of these dollars and doing the contributions. That's at $5,500 per year or $6,500 if you're 50 and older. A conversion is taking some of that IRA 401k, converting it. You got to pay tax on the conversion, but all future growth income principal either way is 100% tax-free. Now, let's talk about another way to do tax-free income, and that's capital gains. So now we're talking about this pool, taxable income pool. So basically it's anything that's outside of a retirement account is going to qualify for a capital gain. So you can own stocks, real estate, in any of these three, but if you own stocks here, that's taxed at what? Ordinary income. If you own stocks here and tax-free, that's tax-free. Capital gains are right here, and typically capital gains are taxed at 15% for most folks, but let's talk about how to get zero capital gains. So number one, we got to look at the tax rates. The ordinary income rates start at 10% and they go as high as 39.6. So that's your potential rates. Now, look at this. If you're in the 10% bracket or 15% bracket, I'll get to that just a minute, your capital gains are taxed at zero. I repeat, your capital gains are taxed at zero when you're in these lower brackets.
Yeah, and so, Al, a capital gain too. Let's say if I buy a mutual fund for $5,000, now it's worth $10,000. If it's outside of my retirement account, I have a tax on that $5,000 gain. Usually it's 15%, but if I'm in those brackets, it's what, zero?
It's zero. And so those brackets relate to taxable income. So go to line 43, your tax return. Take a look at what that number is. If you're married and it's below $75,000, you're in the 15% bracket. If you're single and it's below about $37,500, you're in the 15% bracket, meaning that you can sell some of your capital gains and pay no tax whatsoever. Also, qualified dividends related to stocks outside of retirement, those are taxed at the capital gain rates, which is also taxed at zero when you're in the lower rates. Now here's another one. This will apply to virtually anybody that has stocks outside a retirement account. And take a look at this. This is just, hypothetical stock starting in 2002. It went way up, and then what happened? The Great Recession, it went down, and now it's back up again. So you have an opportunity. It's called tax loss harvesting. And here it is. When the market is down, you actually want to sell that stock, because when you sell that stock, you create a loss on your tax return. It's really important, though, when you sell the stock, it's not like you want to lose money, but the reality is stocks sometimes go down. You buy another stock or mutual fund that's very much the same, so you're still in the market. And when the market recovers, you receive the recovery. In the meantime, you've got this loss that shows up on your tax return, and that loss nets against dollar for dollar against future capital gains, whether it's the current year or if you don't have enough gains, it carries over for the rest of your life. People don't realize this. When you have a capital loss, let's say you have a $50,000 capital loss and you have a $50,000 capital gain on another asset like a stock, sale, real estate, you can net those two together and pay no tax whatsoever.
One of the most confusing things here, Al, is that most people, when they look at a capital loss, they'll say, well, I can only write off $3,000. But that's not the case. I mean, if you have a $10,000, $20,000, $50,000 capital loss, let's say, depending on the size of your portfolio, that's fairly easy to do, is that now that capital loss will offset any capital gains, and that will carry over for the rest of your life until you use them all up. The $3,000 carryover is against ordinary income, and Al, I think a lot of people get confused a little bit on that.
Well, they do, Joe. And so to reiterate, so capital gain or capital losses net against capital gains dollar for dollar. Quick example. So I've got a stock. I bought it for $100,000. Now it's worth $50,000. I sell it. I got a $50,000 loss. That shows up on my tax return. If I have no more capital gains, I'm allowed to take $3,000 of that $50,000 loss, use that against ordinary income for salaries, interest, dividends, and then I carry forward $47,000 next year. Next year I do the same thing. I look at it, what are my capital gains? Well, next year I sell a stock, I bought it for $5,000, I sell it for $15,000. Okay, I got a $10,000 gain. That gain nets against that $47,000 carry forward, dollar for dollar. Now I've got a $37,000 loss, and I still get another $3,000 to use against ordinary income. The rest, $34,000, then carries forward to next year. You never lose these carry forwards as long as you're living, so there's no reason not to do this this tax loss harvesting when it's available.
Yeah, I mean, stocks are risky. Stocks go up, stocks go down. And so when stocks go down, it might be a good time to take a look at some tax planning here. We're not saying selling, going to cash, because it will take you forever to get caught back up. But if I sell mutual fund A and buy mutual fund B, something similar, still keep the integrity of my portfolio solid as that market recovers. And now it's time for me to create retirement income. I got to take $5,000 from the portfolio, $10,000, $15,000, whatever it is. Those gains will offset against those losses dollar for dollar. And guess what? You just created another tax-free pool when it comes to creating retirement income. If you can control the taxes, you're going to be better off, because then you can control your risk. Think about it. You can take on a lot less risk in the portfolio. You still have the same income because you're giving that much less to Uncle Sam. We got about 6 or 7 more to go through, so don't go anywhere. When we get back, Al and I are going to just wrap it through a bunch of things that you want to make sure that you take a look at if you're at all concerned about taxes. Show's called Your Money, Your Wealth.
Hi, my name is Mike Bernier, Certified Financial Planner with Pure Financial Advisors, and welcome to the question of the week. Now, this week's question is, can I deduct the losses on my rental real estate? And it depends. If you're considered a real estate professional, then the answer is yes. Most likely you can take those losses against other income. If you're not a real estate professional, then it depends on a couple things. One is whether or not you have what's called active participation. What that would be defined as is, do you actively participate in some of the management decisions, and do you own more than 10% of that property? If that is the case and you satisfy that requirement, well, then it depends on your income. If your modified adjusted gross income is less than $100,000, then you could potentially deduct $25,000 of these passive losses. If it's over $100,000, then it starts getting phased out. And once it crosses over $150,000 of modified adjusted gross income, you completely lose the ability to take those losses. However, under any of these circumstances, if you're not able to take the loss, you don't lose it forever. It does carry forward as a passive loss carryover.
Welcome back to the program. Thanks for joining us today. Joe Anderson here, certified financial planner with Alan Clopine. He's a CPA. Talking tax-free income. Stick around this segment. We're going to jam in about 6 or 7 different ways on how to create tax-free income. But before we do that, let's go back to the true-false question.
Roth IRAs do not have hidden administration costs like a 401k and allow for penalty-free distributions prior to turning 59 and a half.
Well, it's true and false, right?
Yeah,
because any investment that you choose, right, if it's a Roth IRA or any other investment, will have administration fees. So you want to be careful with any investment that you choose to make sure that you identify and get some transparency of exactly what you're paying for. There's a lot of administration fees in 401k plans, and there's less in Roth IRAs. There's a custodial fee, but then you have to take a look at the fees in the underlying investment. What type, are you in a mutual fund, a stock? I mean, the list goes on and on. So just my advice there from the fee standpoint is just get some transparency so you know exactly what you're paying for. And Al, can you get out of it prior to 59 and a half? Is the the other part of it?
Well, it's a good question because we know that with an IRA, typically you've got to wait till 59 and a half to draw money out without penalty. With a 401k, if you're terminated from service, if you retire, and you're 55 years of age, you can actually pull the money out of the 401k. Of course, yes, you will pay taxes on that, but there is no penalty. So that's true, but it's not before age 55. If you're before age 55, or even if you are 55 and are still working with the company, you can't take money out of a 401k without a penalty.
But you can take money out of a Roth IRA at any age as long as it's a contribution. So it has
Correct.
five-fold tax treatment, first in, first out. So if I contribute to a Roth IRA, I can always pull that money out. Anytime, any age, no taxes, no penalties, nothing. Just the earnings need to be in that Roth IRA for 5 years or 59 and a half, whichever is longer. See, a simple question like that, we could go for hours. This is ridiculous.
You're right about that.
Let's go to the let's talk tax-free income, Big Al.
Yeah, let's give you 6 or 7 more ways. So one is municipal bonds. Did you know that California municipal bonds are 100% tax-free, meaning that the interest income that you earn from them, as long as you're a California resident, you won't pay any taxes on those. And the second one being selling your home. If you have a residence that you've lived in for at least 2 out of the last 5 years, if you're single, you get to exclude up to $250,000 of gain. If you're married, you get to exclude up to $500,000 of gain. And the old rules were, it used to be a once in a lifetime, right? And you had to do a rollover. Not anymore. Now it's every single home that you've lived in 2 out of the last 5 years, you get that exclusion, unless it was a rental first. Then it's more complicated. Give us a call on that one. It's too complicated to go over in 2 minutes.
But you know, how many times do people think it's the old rules? Those rules changed 15 years ago, or even more, didn't it?
Right. Yeah, exactly. Joe, also, let's see, renting your home for less than 14 days under the vacation home rules, that's tax-free. Let me give you 3 more really quickly. You can move to a tax-free state. Not federal tax-free, but state tax-free. What are those state tax-free states? Well, you may know about Nevada. You don't pay any taxes there. But how about Washington State, Texas, Florida, Wyoming, South Dakota, Tennessee, New Hampshire, and Alaska? Those are your tax-free states. If you don't want to pay income taxes to the state, you move to those states. Then finally, 529 plans if you're saving for kids' college. HSA plans, you can put money in, get a tax deduction. It grows tax-free as long as those funds are used for medical.
And one last one, maybe a reverse mortgage. So you can take money out of the equity out of your home, create some tax-free income there as well. So there's multiple ways to create tax-free income. It's just putting all these things together to make sure what's going to make sense for you. Map this thing out, and I'm telling you, you can make your money grow that much longer if you cut the middleman out, and that's Uncle Sam right out of the picture. Let's flip the show over to you, and let's get to some of your email questions.
All right, we've got Marvin from Bay Park, and he asks, are my Medicare benefits affected if I delay retirement until after age 65? That's actually a very good question. Joe, what do you think?
So Marvin, here's what you want to do. If you're still going to work, I think a lot of people are still working in their late 60s and even 70s. So if Medicare kicks in at age 65, I would still absolutely apply for Medicare 3 months prior to your 65th birthday. Because sometimes your employer then will say Medicare is the primary, and then your employer benefit might be, it's not going to be infected at all, but you want to make sure that you apply for it. Have it there at age 65, even though you're still working. That's my best advice. Let's go to the next one.
Next one is from Ann in Coronado. She says, I have a small business. Is it better if I have a simplified employer pension or an individual 401k to save for my retirement? That's another great question. And Ann, I would say this. First of all, if you don't have any employees, your best bet is a solo 401k. Why? Because you can actually put in $18,000 per year, dollar for dollar of your income, number one. Now, if you're 50 and older, it's actually $24,000. And you can do an employer match, and the employer match can be up to 20% of your bottom line profit. Unless you're incorporated, then it's 25% of your salary. Compare that to a simplified employer pension plan. That's only the employer part. It's those same rules, 20% of profit or 25% of salary. but that's all you're limited to. You don't get to do the $18,000 and $24,000 on top of that.
Yeah, I think the solo 401k is a much better way to go. You have a little bit more flexibility in a sense of that you can put a little bit more in or a little less in depending on what your overall income is in that given year. However, the solo 401k you have to set up in the calendar year. I think a lot of you small business owners have a SEP plan, and the reason for that is that you're able to fund it all the way until October, right? A solo 401k plan, you have to fund at least the 401k part in the calendar year. Then you could do your match, though, all the way until October. So check that out. A solo 401k might be a better way to go. You have a little bit more flexibility. It's a newer plan, but let's go to the last one, Alan, and let's wrap this thing up.
All right, real quickly. I think this is Alex Point Loma. I'm 56-year-old and behind in funding my retirement plan. Since interest rates are low, what's the best way for me to catch up with the money I need to retire? Joe, what do you say?
Save. Save, Alex.
That's right.
Save as much as you can, buddy.
Put
the money into the 401k, take advantage of the match, go with a Roth IRA if you can do that. It's never too late to start, though. What Al and I see quite often is that, all right, I'm in my 50s, I'm in my 60s, I haven't done any planning, I haven't done any savings, and it's like, oh my gosh, I can't do this. No, there's never a time to stop. Just take a look at what you're trying to accomplish, set some goals, start saving some money, and I tell you what, you'll be able to accomplish any goal that you achieve. All right, that is it for us. Hopefully you enjoyed the show. All of you now know about tax-free income. Join us next week because we're going to get into charitable planning. So if you want to be charitably inclined, stick around till next week. For Big Al Clopine, I'm Joe Anderson. You just watched another episode of Your Money, Your Wealth.